Hey guys, ooh, happy Thursday. Sorry, I know we're a little late, but technology. I am finding my list of questions. For those of you that are coming in live, go ahead. If you have questions, go ahead and put them in the chat, and I will always attend to those first. Excuse me. Let's see. Let me pull. All right, no one's on yet anyway. So if you're watching this on a replay, sorry, fast forward like 30 seconds. Let's see. This is not working. Okay. It doesn't look like it. Sorry, guys. I'm going to sit here until I know that this is actually working. Let's see. Okay. Okay, good. We're live. Okay. Hello. Happy Thursday. Welcome. 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 As I try to figure out, I just closed my Q&A spreadsheet that my VA compiled from all the questions you guys have sent in, which we got some really good questions in. So thank you. Thank you to those of you that DM'd yours in, and you're probably maybe watching on replay and not watching live, and that's why you messaged them in. So thank you. But if you are here live and you do have questions, go ahead and stick those in the chat because those will always be top priority. And then my list will be second as soon as I find it. All right. So if you are new here, hi, I'm Bree Beers. I own Bree Beers and Associates in Denver, Colorado. We are a tax strategy and advising firm, and we do tax prep as well. We work with clients across the country, and we really focus on tax advising and tax strategy, tax planning. Even within our tax prep for clients, we really try to make sure we're maximizing the deductions based on what we see. And then we do have, we have tax prep season and then tax planning. And the reason we have tax planning season, you guys, is because the tax code, it really is built for all of us. A lot of people think it's reserved for the rich and the wealthy. And while they are the ones that do get to take the most advantage of it, there are plenty of areas of opportunity in our current tax code that are accessible to you and me, normal business owners. But it's just a matter of understanding how to utilize it, right? How to make sure we're maximizing the deductions available and making sure we're staying compliant in all the documentation. And that's what we do at Bree Beers and Associates. I cannot for the life of me find this dang spreadsheet. So I'm going to go by memory. That's dangerous. But again, as you're joining us live, go ahead and put your questions in the comments if you have them. So I got a lot of DMs asking, just for quick reminders about deadlines, and especially for businesses, because it gets a little confusing. So I'm going to start there, especially because our first deadline is right around the corner. So if you have an S corporation or a partnership, all right, so S corp means you've elected to be taxed as an S corp. This is something you would know. It's not something that just like happens. You have to actually make that election. So if you are elected to be taxed as an S corporation, or you're in a partnership, meaning you and at least one other person own the business together, all right, then your business return, you have a separate business return that you have to file, and it is due usually March 15th. This year, March 15th is the deadline, so you have until March 17th. That is Monday. Do not freak out. If this is you and you're just like, oh my gosh, whether it's I haven't even thought about taxes, or you know what, I gave all my stuff to my tax accountant and I haven't heard from them, reach out, right? And what you guys can do is, if you're not ready to actually file your business return, you can file an extension, right? There's no cost, no penalty for filing an extension for your business. But what that does is it gives you up until September 15th to file your business return. And for many people, what that does is it gives you the few extra weeks or even months to just get your business return filed before you have to file your personal return. Okay, hold on. Let me go shut my door because I hear the dogs. Okay. Sorry. And so filing an extension, there's no penalty, but what filing an extension does is it avoids penalties. All right. If you don't file an extension for your business return that is due on Monday, March 17th, and you don't file an extension and you file even 1 month late, the penalties, I think they're now $300 or $310 per owner, per shareholder, per partner, per month late. All right. So even if you don't file an extension and you're 1 day late and there's only one of you, you're looking at a $300 penalty. And filing an extension is super easy. All right. The reason I got this question a lot this last week, though, is from my clients, the taxpayers out there who have Schedule C businesses, right? They have LLCs or sole proprietorships, or they receive contractor pay. All right. So if you didn't make an S Corp election, you're not a C corporation, which I don't think there's very many of you guys in there, if at all, in this group. And if you're not in a partnership, it's just you that is the owner. Then what you do is, whether you are a contractor, a sole proprietor, a single member LLC, any of those legal types, or like how your business is run, your tax type is a Schedule C. And a Schedule C business simply files their business information on an additional schedule within your personal return. Okay. So all of us filed our Form 1040. That's our personal tax return. And if you have a small business or any of those things I just said, and as long as you have not elected to be an S Corp, or you are not a C corporation and you're not in a partnership, then you simply report your business activity within your personal return. All right. And that's not due till April 15th. All right. So we got a little bit of time there. Same thing though, you guys, April 15th, if for some reason you cannot get your tax return done, you can't get your documents together, maybe you're, for whatever reason, file an extension. All right. Always make sure you file an extension if you cannot file by the deadline, because that is going to avoid your failure to file penalties, which are 5% of what is due per month. Okay. So that was the number one question I got through this week was, wait, when are my deadlines? When is my tax return due? What about my business? So I wanted to address that one first. The second most, I got this question kind of asked in 3 or 4 different ways. And that was about estimated tax payments. All right. So I got a few different questions, and this was asked a few different ways. We got, when are my estimated tax payments due? Do I have to pay estimated tax payments? How are they calculated? I kind of got all these questions along the board. So I just want to give a general kind of explanation of what your estimated tax payments are. All right. So when you are just a W-2 employee, and I don't say just like there's anything demeaning, it's just you only have one source of revenue, right? And it comes from your W-2. And when you have a W-2, they withhold taxes, right? Whether they withhold too much, not enough, just the right amount, that's not the point here. The point, you can work what's called your W-4 form, and you can fill that out in a way where they essentially can take out the exact amount you owe every year. Okay. None of us are that, very few of us are that meticulous, and this current form is kind of a SHIT show, but that's the theory, is that all of your earnings come from your W-2. Therefore, you can make it so all of your withholding gets taken out of your W-2. In which case, you just file your return, and then you either get a refund or maybe you owe a little bit of money, but you do not need estimated tax payments when you have a W-2, and you can just have your taxes withheld. Right? Estimated tax payments are due for those of us that have income coming from somewhere else. All right. So this can be if you have investments and you make a lot of money on capital gains or dividends or interest. All right. You might have to make estimated payments, but more commonly it's for our business owners. All right. Again, whether we're partnerships, whether we're S Corps and we're, making above and beyond what we're taking as our reasonable compensation, or we're Schedule C businesses. Remember that Schedule C businesses are all of our contractors, sole proprietors, single member LLCs. Okay. Regardless. So when we have income from any of these activities from a business, all right, we are responsible for paying our own taxes, all right, and withholding them. And that's where estimated payments come into play. All right. And some people, we get a lot of different scenarios like, hey, my husband's a W-2, but I own my business. What does that mean? or, we're both self-employed. What does that mean? Every taxpayer is going to be different, but in general, here's how estimated tax payments work. All right. So again, when you're a W-2, you have taxes withheld. When you're self-employed, you do not. And so when you're self-employed, the IRS says, hey, you have the option of paying us quarterly. And there's a few ways you can calculate that. All right. The first, it's called, I don't know what it's called. It's not called anything. But when your tax preparer prepares your return, so let's say we just prepared a 2024 tax return for a client. All right. We are out of our system, and every taxpayer, this is not just us, this is every tax preparer out there. All right. They are going to project what your income is going to be for 2025. And what they're going to say, and it defaults, unless you tell your tax preparer otherwise, your tax preparer's software is going to say, hi, Jaden. My VA gave me my Google sheet. So after I run out of questions that I remembered, I can result it. Thank you, Jaden, if you're on here. Okay, so back to estimated payments. So I prepare a 2024 tax return for a client, and what the estimated tax payments that we're going to project for 2025 say is if your 2025 tax picture is exactly like 2024, here is what you should pay in each quarter. Okay. And the reason we do this is the bare minimum that I think every tax preparer does. And what that does is it sets a baseline for you as the taxpayer on what you should expect to pay each quarter. So you can save, so you can budget. But the reason these numbers, why they're suggested, is to avoid any underpayment penalties, because what the IRS says, they have tons of types of penalties. Okay. We already talked about the failure to file penalty. Another one is an underpayment penalty. And what the IRS says is that in a tax year, within the confines of the calendar year, you've got to pay in either 100% of this year's tax liability or 90% of what you made last year. For high income earners, they say 110%, but regardless. So, and the reason that rule set is so we create these estimated tax payments saying, okay, here's what you made in 2024. So here's what you should pay this year. And what we're doing is avoiding that underpayment penalty. Because what this allows you to do as a business owner is, even if your income skyrockets at some point, or, your business blows up, because you're paying in this 100% of what you owed the year before, you're going to avoid the underpayment penalty. All right. So that at its bare minimum is, so when estimated tax payments are projected for an upcoming year, that's what it's based off of. Now we get clients, and part of what we do in our tax advisory services is we can calculate estimated tax payments like in real time. So when quarterly estimated tax payments are made throughout the quarter or throughout the year, each quarter, we can actually estimate, okay, based on your actual business activity, what you made, what you brought in, what you spent for this quarter, here's what you should actually be making. And we can adjust those estimated quarterly tax payments. All right. And you can do that as well. What we tell people, this is a very conservative estimate, but your revenue minus your expenses for the quarter, whatever that number is, we tell people whether you pay it or save it, 40% is pretty safe. And that's because you're accounting for your income tax, your self-employment tax, and your state income tax, if you have that in the state you're in. All right. And that's going to, again, fluctuate depending on what state you're at, depending on how much you make, but without knowing your exact tax picture, that's a very rough number, okay, to set aside or to pay in. All right. All right. Now let me go. I don't see any in the comments. Again, I do see a few of you here live on the different platforms. So if you guys have any questions, please feel free to throw those in the chat and I'll answer them. Otherwise, I'll just keep going down the list of the ones that came in over the last week or so. Someone asked about capital gains. Okay, this is a great question. It's a little complex. So I'm going to try to figure out, I'm just going to kind of keep it high level. Okay. So when we file our tax returns, most of our income is considered ordinary, right? It's ordinary income. It's income that we earned, right? Through a job, through a business, and that is taxed at our marginal tax rate, all right? And that's when we hear about what tax rate are you in, it goes 10, 12, 15, 22, 24, 27, 32, 37, maybe. 37 is our highest tax bracket, okay? And it's for the, 400,000 plus, I think, earners. But that's our income tax. That's on our earned income, money that we are trading time or value to someone else to receive money in exchange. Okay, so think business income, W-2 income, right? Earned income. Then you have passive income. But what you have, you guys, what we talk about with capital gains is long-term capital gains. All right. Short-term is different. It's considered ordinary, but long-term capital gains. All right. So what is that and why is it important that you kind of know that this is different than earned income? All right. And that's because long-term capital gains are taxed at what we call preferential tax rates. Some of us are so for the first section of capital gains that we experience or that we have to report, it's actually 0% income tax. And then it's 15, which is where most income kind of falls into. And then for our high earners who made a ton of money on income, it can go as high as 20%. But even 20%, you guys, think about that. Even 20% income tax is lower than what most of us, so 22 and 24% tax rates are the most common for taxpayers in here, okay? For our demographic, small business owners. So 20% is lower than what we're paying, right? So capital gains is on long-term investments. So think your brokerage statement, okay? When your broker is buying and selling stocks, all right, when you sell stocks in a year and you make money or lose money, that's a loss, but you make money that you've held the stock for more than a year, it's long-term capital gains. And you're going to get that preferential tax bracket, 0, 15, or 20%. All right. Also think of it when you sell real estate. All right. When you sell your primary home. All right. Yes, we get this exclusion that I know a lot of us know about. It's $250 per person or $500 for married filing jointly. All right, so we get to exclude that number. But if we made more than that when we sell our primary residence, and we're in the house for more than a year, that is capital gains. When you sell a rental property, capital gains. If you sell a house that you inherited, capital gains. All right, anytime you sell an investment of some sort that you've held for over a year, crypto, okay? All three of these things are the biggest things I can think of, all right? If you've held it for more than a year and it's an investment, then you're subject to the preferential capital gains tax rates, all right? So that is something just to kind of know that there's a difference there, okay? Let me see what else. There was a few other things that I got multiple iterations of the same question. So let me peek. Okay. Should I be an LLC, an S Corp, or a C Corp to save on taxes? And the first thing I'm always going to tell you is there are legal differences between all three of these. And so start with the legal side. Okay. And what does each one do for you legally? All right. And when we talk about LLCs, S Corps, and C Corps, okay, the one thing to remember is that S Corp is only a tax election. Okay. It is not a legal election. You have to be an LLC or a C Corp or a partnership taxed as an S Corp. All right. And I know if you've been here a while, I always say that, but it's just an important thing to remember. Okay. And so then so which one saves you on taxes? And that's going to depend on your picture. All right. It's always going to depend on your picture. And this is why you should always talk. If you have a tax preparer, have this conversation with them. If they can advise you on this, or maybe they don't, because not all tax preparers also give advice. But find a tax advisor that does what we do at Bree Beers and Associates and can sit down with you and look over the differences of each of these. So as soon as you set up a legal structure, all right, it defaults to either an LLC, if it's just you, a partnership, if you're in business with one other person, or you can set your business up as a C corporation, as a corporation. All right. C corporations are really reserved for people who want to get either go into public, like want to go public, or maybe want to do a lot of venture capital, things like that. That is what C corps, like in terms of the very few clients we have that are C corps, that's who it is. Because C corps give you the flexibility to kind of grow and have multiple owners without a lot of complexity. And C corp it right now, 21%. Whether you make $1 or a bazillion dollars, you're taxed at 20%. There's a lot of different rules and stuff that apply that we're not going to get into because I know there's not a lot of C corps in here, but that's it. Okay. LLCs and partnerships and S corps all are taxed based on you personally. Okay. So even though if you have a partnership or an S corp, there's a separate tax return, but it's a reporting instrument. Okay, you guys, it's reporting income and then telling each owner how much of the income they have to report and then issuing a K-1 to the owners, and the owners report that as income on their personal return. Just as we do a W-2 or a 1099, it's a reporting form from another entity that tells us how much money we made from that entity and how much we have to report. All right. And with S corps, the tax benefit comes when on the self-employment tax side. All right. So from the income tax side, they're all taxed the same. All right. LLCs, partnerships, and S corps are all what we call flow-through entities, and they're all taxed based on the owner's tax picture. Okay. The S corp does have potential tax savings when it comes to self-employment tax. All right. So when we have a partnership and we make money from that partnership, or we have a Schedule C business, meaning LLC or contractor, sole proprietor, all of that income is subject to our income tax at whatever bracket we're in, right? But it's also subject to self-employment tax, which is 15.2%. All right. The equivalent of payroll tax, right? When we have a W-2 job, we pay half of that. Our employer pays half of that in Social Security, FICA, Medicare. All right. So self-employment tax replaces that. It's the way of the government still getting their FICA, Social Security, and Medicare taxes from those of us that are self-employed. Okay, so the S corp comes into place. S corp, when you work in an S corp, you have to run yourself a reasonable salary, which is not an easy, it's just not a flat number. It's something we do reasonable comp analysis at Previous Associates, and I think a lot of accountants should, and I think are starting to. But the reasonable comp, okay, let's say we do a reasonable comp and your reasonable compensation is 70 grand. 70 to 80 is kind of the minimum. All right. Anything above and beyond that. So you're going to run a payroll. You're going to be a W-2 employee in your S corp. You're going to run a payroll for that 70,000. You're going to pay payroll taxes on that 70,000. But then anything above and beyond that you make is free of self-employment tax. So when we compare like maybe an LLC to an S corp, an LLC that makes 100 grand net. Okay, that's the important net. So all of our revenue minus our expenses equals our net, give or take, right? So we have $100,000 in net income. If we're an LLC, then we are going to pay our income tax on that $100,000. And then we're also going to pay 15.2% self-employment tax. So about just over 15 grand in self-employment taxes. If we elect to be an S corp, okay, there are additional responsibilities and expenses related to this. So this is not cut and dry, but just, again, big picture. We do a reasonable comp and it's 70 grand. Okay. So our S corp pays us a W-2 for 70 grand, pay all our payroll taxes, our 15.2 plus a little more, like 16-ish, we'll say percent payroll taxes on that 70 grand. That other 30 grand, okay, is free from that self-employment or payroll tax. So we save, where's my calc? 30,000 times 0.152. So we saved about $4,500 $100 in taxes by making that election. All right. Making an S Corp election is something that I don't ever want to see any taxpayers doing without consulting with a tax advisor. All right. And when you consult with a tax advisor, if they are only showing you the savings and not explaining the additional responsibilities and expenses related to it, that is a red flag. All right. So ask, right? Say, hey, what's the downside, or what's the flip side? I see the tax savings. What else is there? What's the catch, right? And the catch is there's a separate tax return. That's an additional expense. You have to run payroll. That's an additional expense. You have some compliance pieces from a legal point of view. That could be an expense, but it's a responsibility. All right. So talk to an advisor that is going to give you both sides of this. All right. Because unfortunately, there are a lot of accountants out there that just go, oh my gosh, it should be an S Corp. It's going to save you X amount of, dollars. Like, let's do it. And they do it. And then they're like, okay, bye. And they don't explain the flip side to that. The other big piece to that S Corp election, you guys, is making sure it is a reasonable salary. All right. We get lots of S Corp people coming in that are running like a $20,000 or $30,000 salary. Now, I just tell you, like, yes, reasonable comp is a little complicated, but things you need to ask yourself. If an accountant gives you a reasonable compensation or like salary quote, could I hire someone to do everything I do in my business for that amount? What would someone else pay me to do what I do in my business? All right. Those two questions are the first kind of line of defense. And $30,000 is very rarely going to cover that. All right. So it used to be 50. Now with inflation and the cost of living going up, 70 to 80 is kind of what we call our base. All right. Esther, hello. How are you? Let's see. Asking for long-term capital gains. If one had no other income that year except the income from capital gains, like crypto, okay, would they be in the 0% tax bracket, or would the capital gains be counted in their AGI and bump them into the higher tax category? Also, is one supposed to pay capital gains quarterly or annually? Great question. Okay. Okay. Few pieces here. So let's start with, so if that's your only income, okay, so can't even so all you did was live off, whether it's your, like she said, crypto, maybe you sell a rental property. No, because then you'd have rental income. Let's say you sell a property that you inherited, something. You don't have to work. Okay. So you have no other income. It's just this capital gains sale. Would they be in the 0% tax bracket, or would the capital gains income be counted in their AGI? It is counted in your AGI. So it can, yes, this is such a great question. Your capital gains can kick up your other income. Okay. So this one says you have no other income. So in that case, it wouldn't matter, right? If all you have is your capital gains, then all you care about is the 0, 15, 20% capital gains tax brackets. But this is such a great question. Most of us, that's not our case, right? Most of us have a job, we have a business, we have some other income coming in. So let's say normally I'm, $100,000. Okay. I make $100,000 a year from whatever. All right. So I'm in the my brain's off. Let's just say I'm in the 22% tax bracket normally. Okay. Can't remember if that's right. I don't have it memorized, guys. Sue me. But this year I have this huge, let's say I inherit a house and I sell it and I make $1 million, right? That is going to kick me up to the 37% tax bracket. And there is this, it's such a hard calculation. So what I suggest, so just to make sure it's right, because you can do this wrong. You can so easily do this wrong, even as a tax preparer. So if you ever have a year where you have big capital gains, your tax return, first of all, do not use TurboTax or H&R Block. Just don't, because these are also the kinds of tax returns that get not audited, and not even flagged, but like sent, like IRS notices sent, like, hey, we have questions on this. All right. You don't want to be dealing with that. So either use a physical person at H&R Block and get like their audit protection or whatever, or use an actual tax preparer. Because first of all, hopefully an actual accountant person is going to make sure the compliance pieces are right to avoid unnecessary notices. But then they're going to be there to answer these notices when they, if and when they come. But your works, there's always going to be a capital gains worksheet. Look at that in a year you have a capital gain, and it'll explain to you what income's coming from capital gains, what is coming from ordinary income, and how that's flooded in your tax brackets. It's a very good schedule or worksheet to kind of explain that for you. Second part to that question, kind of also, is one supposed to pay capital gains taxes quarterly or annually? The right answer is you pay it when you see it, right? So when it's one big sale, so you talked about crypto, and I'll come back to that. But like if you sell a property or you have one big lump sum in capital gains, you should make an estimated tax payment in that quarter. All right, so that's that. If it comes to things you're doing throughout the year, all right, so let's say you're in crypto, or you guys, most of you, the stock market, right? And you have activity going on throughout the year. It's as long as you meet that threshold of did you pay in as much as you made last year or owed last year, you'll avoid underpayment penalties if you wait till the end of the year. All right, but I always tell people, like, there's a cash flow matching to this, right? And part of paying quarterly estimated tax payments is to pay the tax when you actually made the money. And so I will always recommend, if possible, because I get there's a difference between like what do you recommend and what is like actually feasible. And it depends on your situation. But I would always recommend doing it quarterly. So if you're investing, right, then what you can do is you can pull a quarterly investment statement, whether it's from brokerage, like from your brokerage, or you can run reports in almost all the crypto platforms and see what your gain or loss for the quarter is. Okay. And then you can see if it's short-term or long-term. And so it'll give you like a total for that period, and make your quarterly estimated tax payments based on that each quarter. If you're doing a ton of this, if it's very minimal or it's not a lot, I wouldn't worry about it. But if this is you started with, if this is where your income is coming from, then I would absolutely be doing this on a quarterly basis to match your tax payments with when you're making money, so that cash, matches up, to avoid, or to make sure you're, paying on time to avoid underpayment penalties. And there was a third reason I wanted to suggest that. No, I forgot. So it's fine. Great question. Okay. We are at our 30-minute mark. I don't see any other questions. I'll wait for like 20 seconds in case anyone, there's like 4 or 5 of you on here between all of our, still on here out of all of our live. So if you have questions, throw them in the chat. Otherwise, I will tell you what is going on next week. I don't know what's going on next week. Let's look. Lives. Live training topics. Reminders. I know I started the session with this, but in case you missed it, a reminder of upcoming deadlines. Usually March 15th is our S Corp and partnership deadline. This year it is March 17th. That is Monday. If your tax return is not ready to go, file an extension and then file it when it is. And then for our personal returns and our C corporations, they're due April 15th. Same thing. If you cannot get it done, or for whatever reason, at the very minimum, file an extension. Really, the best thing is to file an extension with a payment of anything that you think is going to be due. The best thing is to file it if you're ready. What date are we on? It's the 13th today. So next week. Oh, I'm gone next week. I'll see you guys in 2 weeks. Duh. Next week is spring break. So I will be in Santa Fe. I'll be working because it's tax season, but I'll be working where it's warm. So hopefully I'll be hanging out with the family some too. So no training next week, the week after. So I will see you guys on the 27th. We're going to talk about deadlines. I know I did that today in the Q&A, so you may not need to join, but we're going to talk about deadlines. And I'll do I always, if I have time, guys, do some Q&A at the end. So yeah, so that is it. Have a great day. Have a great weekend. And see you guys in 2 weeks.